Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, Tim Miller. G'day, Tim. How are you?
You're going pretty well, Aaron. How are you doing?
Not too bad. Like everyone at this time of year, they're up to their eyeballs with maybe tax lodgements or around tax planning, and even some considerations off the back of the recent federal election result, which no doubt Division 296 will become a topic that we'll be talking about again in the not too distant future. But I digress. We are going to focus today on the timing of super contributions and importantly, member contributions and notices of intent. This was an area of significant interest in our recent SMSF tax planning webinar and comes with a number of opportunities when we make contributions, but equally a number of traps. So I'm going to get you to, I guess, deep dive into that a little bit and explore some of these things that we went through in our tax planning session and what people need to understand when putting that notice in play to ensure that it is valid.
Yeah, look, so it's an interesting one. And, what I'd say right off the bat, that there's recently been a case of a contribution made late in the year where the member thought they'd made it before the 30th of June, but the fund received it after the 1st of July, and they straight out asked the commissioner if they could bring it into account at 30 June and claim a deduction. The commissioner said no, so no consideration or opportunity there, no discretion. And then, of course, there's a well and truly a history of cases where people have made their contributions on time, and then have provided their notice of intention outside of the appropriate time limit, and then again have asked the commissioner for discretion, to which they've received no joy. So it's one of those areas from an Income Tax Act point of view where there is no discretion available for people if they get it wrong. And so it's really important that they understand the key issues around timing. And those key issues ultimately are that if you are making a deduction, if you are wanting to claim a deduction, you must provide that notice of intention to claim to the trustees of your fund, and there must be an acknowledgement of that deduction being made or being claimed. And from a timing point of view, the way that it requires in a standard scenario is that that notice of intention must be provided by the earlier of the day that you lodge your personal tax return, or the 30th of June following the year in which the contribution is made. So effectively, it means if you're a late lodger and you lodge beyond 30 June a year later, then 30 June is your cutoff date. So in a normal set of circumstances, you've effectively got up until you lodge your personal return to provide that notice of intention to claim the tax deduction. However, where it gets more complex is there are rules around deductibility, and those rules stem from whether or not any action or activity has occurred with the monies linked to that contribution. And probably the easiest way to explain that is if you go and do something like commence a pension, then you need to determine the tax-free and taxable components associated with that pension. And so therefore, to have accurate tax-free and taxable components, you must ensure that any notice of intention to claim for any contributions that form part of that pension, that notice must be in before the pension commencement date.
Yeah, so the interesting there, Tim, is we will commonly see scenarios now where we've seen contributions being made alongside retirement phase income streams.
Yeah.
And the fact that that can be done through to age 75. Of course, there's a work test that needs to be met between that 67 to 75 years of age, but there's a closer alignment to those things. So the validity of that notice, therefore, is incumbent upon the contribution being made, one, but then ensuring that that notice is signed and completed prior to the commencement of the income stream, or the validity of that is simply null and void.
Yeah, that's right. And so, referencing your point there about the 67 to 75 piece, so we can make non-concessional contributions effectively unencumbered. So right up until 75, we can make non-concessional without any references to work test. The work test requirement is to be able to claim that personal tax deduction. And so if we've got money coming in where we're wanting to claim a deduction, and we are over 67 in that instance, we have to ensure that we satisfy the work test to claim the deduction. But the nuance between contributions and commencing income streams is one that we've got to ensure that we get the timing right, particularly because what is very standard in our industry is a 1 July pension commencement date, because from a valuation point of view, a lot of people make that assumption that it's easy because we get 30 June valuations. And so if we're jumping into the concept of starting a pension on the 1st of July, then ultimately it means we need to ensure that our notice of intention to claim is provided to the fund by the 30th of June.
Yep.
Now, that obviously can often be complex because people are still dealing with their accountant or whoever to determine what size deduction do I need. And so, in effect, you can't commence a pension until you know what you're doing from a deduction point of view. And I will say that, you know, that's one example, commencing a pension. The concept of the validity of notice means if you move that money out of the superannuation environment that it's been put into, right? So if you roll money over to another fund, if you take lump sum benefits, all of these sorts of things can trigger an invalid notice of intention for contributions made prior to that activity happening. Contribution splitting is another example of that.
Yeah. So the other part to this that is interesting to explore that we had questions about in our recent SMSF tax planning session is the fact that you might have an event like a pension being started, but the ability to make the personal deductible contribution hasn't yet finished for that financial year. So, for example, they may want to make a contribution in the month of June and use a reserving strategy to facilitate that double deduction. So the question there becomes, well, what do we have to do? Do we get to vary that original notice, or do we actually have the ability to create multiple notices in one financial year?
Yeah, so the variation of notices is an interesting one, because I think the actual wording of the ATO document is a notice of intention to claim a deduction or to vary that notice or something. It's quite an extensive title, but you can actually only vary a notice downwards, right? And again, there's issues associated with that. But in the scenario where somebody makes a deduction or makes a contribution, claims the deduction to commence their pension, and then makes a subsequent contribution, then in that instance, what they would do is they would then provide another or a further notice of intention to claim a deduction on that particular contribution. So what you cannot do is you cannot vary a notice upwards. So even if you haven't started a pension, if you prepare a notice of intention for an amount, you can't vary that notice upwards. Once you've given that, you have to provide a second notice.
Yeah, so I guess in closing, Tim, is there any other aspects to this opportunity? And obviously we're talking about the claiming of a deduction here, but what people need to be aware of, both in terms of the opportunity to contribute, but then also with the traps, I guess, from implementing this strategy, because it is going to be a heavily used opportunity in the lead up to 30 June this year.
Yeah, look, I think really the key is to have an appreciation for your personal income situation and what your needs might actually be, because you effectively, to be frank, you get one go at it, and you've got to meet the conditions and get it right. Otherwise, you just find yourself in this evolving state of uncertainty whether or not either your accountant has provided that information from a return point of view, whether the super fund has accepted it, and other things. And obviously in an SMSF environment, it's relatively easy because the member and the trustees are the same. Yep. From an acknowledgement piece. But it's really comes down to the whole concept of, what are your plans? So doing a checklist, or effectively an internal checklist of when I make this contribution, is there a likelihood of me wanting to claim a tax deduction, right? If there is, do I need to meet a work test? So am I over 60, 67 in that situation? If age isn't the defining factor, am I going to start an income stream, or am I planning to split this contribution across to my spouse? So ensuring that you get all of the timing elements of it right to make sure that you fully maximize the deductibility for you, but also to ensure that you get the correct components inside your superannuation fund. Because if you fail in any of the processes and the amount is subsequently, or the deduction is subsequently denied, right? If you've commenced your pension, then that will remain as a taxable component right within the fund. But on the other side, if the amount is not treated, if you don't get your notice in, and it's a non-concessional contribution, then it may actually have impact on other planning around the utilisation of the bring forward rules and other things with non-concessional contributions.
Yeah, and that's really why we designed our SMSF tax planning checklist as well, because it helps you to identify the fact that there may be that opportunity for contribution. And we haven't even talked about in today's session the fact that there may be carry forward amounts subject to TSB and so on and so forth. And I guess the final bit that I just wanted to add on to that then is just the dotting your I's and crossing your T's with the documentation, because if you don't get that right and ensure you've got all of those elements around the notice of intent, the acceptance and notification, then you will trip over and ultimately be denied the benefit that you're trying to obtain actually out of the strategy.
Absolutely.
So, all right. Well, thank you once again, mate. Great to catch up. It is a busy time of year, but there are some wonderful opportunities out there in the lead up to 30 June. So thank you once again. Have a great rest of the week. Bye for now.
Always a pleasure. Look forward to catching up next week.
Bye.